Howdy, Team 42. It's your skipper here, Darius Dale, to present our June monthly macro scouting report for 2021. We have over 160 slides of data-driven content to get through, so we don't want to waste any time. So let's just get right into it. Starting with slide 3 here, we have our table of contents, intro to the 42 macro risk management process for those of you who are new, and we thank you for joining us. We'll then head over to our U.S. economic outlook. Then we'll head over to our global economic outlook, followed by our China economic outlook, and then our Europe economic outlook. And then we'll switch over to some key cyclical and secular forces to consider. We kind of think about the world, in terms of where does the intersection of the shorter term cycles really meet the longer term secular forces. So we'll discuss those. And then we'll get into our portfolio construction guidance. We made some changes today in preparation for, continuing to anticipate a market regime transition towards deflation. But you might actually get a Goldilocks sort of mix in between. And then lastly, we're not going to hit on all of this, but we have a reams of grid asset market backtest data supplementing our portfolio construction guidance in the appendix for you guys to check out at your leisure. I'll give you some hints on how to review those tables and charts, but we don't necessarily go through each and every one of them. So here on slide 4, just a reminder, this is our grid framework. This is what we use to measure and map, bottom up macro regime cycles. There's 4 distinct cycles. If you go back to this sort of Dalio tree, where you can have growth accelerating and inflation decelerating, that's Goldilocks. You can have growth accelerating and inflation accelerating at the same time, that's reflation. You can have growth decelerating and inflation accelerating at the same time. We call that inflation. It's also stagflation, but grid sounds a lot better than GRSD. GRSD sounds like something you take to the doctor's office. So we're sticking with grid for now. And then lastly, growth and inflation decelerating simultaneously. That's deflation. On slide 5 here, why does grid work? Well, it works because we're standing on the shoulders of giants. Most of what I've learned is from just following the thoughts and teachings of some of the brightest minds in our industry. If you think about Dalio from a macro and asset allocation perspective, really pioneer in so many respects in terms of not only asset allocation and portfolio construction, but also in terms of how the world thinks about cycles. You got Danny Kahneman and the late Amos Tversky, which really kind of the godfathers of behavior economics, which we use, which we lean on a tremendous amount in our process. And then you can't forget about the late Benoit Mandelbrot, Yale professor. He's the godfather of risk management and actually how to incorporate volatility and other factors into your sort of shorter term to medium term market risk management. So, again, standing on the shoulders of giants. I myself am no guru. I'm just a guy who reads books and does math. And I'm happy to share my learnings from those books and that math with you guys. On slide 6, this is our global macro risk matrix. We use this to measure and map top-down market regime cycles. And so what we're doing is we're looking at 42 key macro market exposures, and we're scoring them from the perspective of our volatility adjusted momentum signal. So a check mark is bullish, exclamation point is neutral, and an X is it's bearish. So if we get a check mark, that means volatility is confirming a trend higher in price. If you get an X, that means volatility is confirming a trend lower in price in terms of the volatility regime being in a regime that has historically perpetuated drawdowns. And then obviously if it's neutral, you could have a trend higher or lower in price that is being disconfirmed by volatility. So that's something. So we're scoring all of the confirming signals, i.e. the bullish and bearish signals across the 4 distinct regimes. On slide 7, just giving you a quick look at what the volatility adjusted momentum signal looks like across the S&P 500, which is still bullish, CRB index, which is still bullish. On slide 8, looking at the US dollar, which is still bearish, and then the 10-year treasury yield, which is still bullish, but looks like it could be flirting with a bearish BAMS breakdown. But going back to what I was saying on slide 9, we're scoring each of those confirming signals, i.e. a check mark or X, in terms of how each asset market exposure has historically behaved across each of these regimes. So you got Goldilocks, that is, asset markets have generally behaved a certain way in Goldilocks according to our grid asset market backtest. They've historically behaved a certain way in inflation, and deflation, and so on. And so what we're doing is, we're scoring each of those signals and then tallying up the scores and the points for each of the asset markets. And on slide 9, or on slide 10 rather, we wind up with the market regime probability. So the regime that has the most signals that is confirming it in terms of the historical behavior of the asset class in that regime that is what we call the dominant market regime. That is the market regime we want to be investing. We want to orient our investments in accordance with. Again, I mentioned this the last month. We don't invest according to what I think. I'm not smart enough to be giving investment advice. I'm smart enough, however, to observe what the market regime probabilities are and how they're changing over time, and communicating that and orienting Team 42's sort of portfolio construction, at least the preponderance of the portfolio construction, in accordance with what the market wants us to do. The market knows it all and is a lot smarter than all of us. On slide 11, this is our dynamic asset allocation framework. So based on the great asset market backtest, we generally know the relative performance of the different asset classes, the four liquid asset classes, on an ex-ante basis. And so these are roughly, and I'm obviously using some pie charts here, but these are roughly the appropriate shares that you should have in each of these regimes. So about 70% equities and commodities and Goldilocks, 30% fixed income and FX. But bump that up to 80% equities and commodities and inflation, 20% fixed income and FX. And then it's kind of the reverse is true when you're in inflation and deflation. And just as an aside, both inflation and deflation are risk-off market regimes according to our back test and according to our framework. On slide 12, so this is kind of the soup to nuts. This is one of the more important slides in terms of how we explain our portfolio construction process. So again, we want to be orienting the preponderance of our exposures in accordance with what the market regime is. Like, what is the market telling me to do? Is it telling me to bet on inflation? Well, that's good. Let me go buy some inflation things. Let me go short things that go down in inflation. But, every so often, 2 or 3 times a year on average, and again, nothing is average, but just observing what happens, observing what happens over the last, 50 years, quarter century of data. There's about 2 to 3 market regime phase transitions that you need to prepare for each year. And so how we think about incorporating that and proactively preparing for that is that we want to start to tiptoe into what we believe is the next most likely market regime. Now, we don't have any information on that ex ante, but we can use our bottom-up macroeconomic regime forecast to sort of anticipate, okay, this is where the next market regime might go. So, for example, in the current setup, we have deflation projected, starting in July in the U.S. economy and in the global economy as well. And so it's our expectation that, okay, the market regime will eventually transition to deflation. Now, I have some thoughts, and I'll explain them as we progress throughout this deck, that might be delayed a month, both, at least from a top-down market regime perspective, but, the process is still the same. So as we're getting to be, within 1 to 3 months out from a market regime, from an expected market regime phase transition, you want to start to tiptoe portions of the portfolio into that expected change of market regime. So when you're 3 months out, you got 10% of your assets in what you believe will be the next market regime based on your pending macro regime forecast. Again, that's the only information we have that gives us confidence in anticipating a change in the market regime. Okay, is the economy going to change? And if the economy changes, we expect asset markets to price that in. So at some point in the next 1 to 3 months, we would expect markets to start to move in that direction. When you're 2 months out, 20%. And then when you're 1 month out, 30%. So again, it's June. I mentioned we have a macro bottom-up macro regime transition projected for July. So we're in that middle circle there. And then at some point between now and August, we would expect the full blue pie to be a deflation. But it's June 7th, and August is a long ways away in terms of managing risk on the buy side for sure. So we definitely don't want to be too early, but we certainly want to be aware of the pending transition and appropriately allocate it to give ourselves some comfort and ability to sleep at night, that we're not over our ski tips long inflation into what is likely to be a deleterious market regime transition in the back half of the year. But again, we're not there yet. On slide 13, this is our updated portfolio construction. So we came into this week, or this presentation, we were long Ethereum, Russia, and corn. Don't like how Ethereum and corn are acting. So we're just going to book the loss in Ethereum, book corn, and then book Russia. But we're rotating into REIT, Swiss francs, and the US dollar. Now, I'm sort of violating my own rules, and we'll touch on this later in the presentation. But one thing we don't do at 42 Macro is buy bearish volatility adjusted momentum signals. However, I learned a lot from watching the asset markets trade on that ADP print last week. It gives me a lot of confidence that, okay, if we have 70% of our portfolio in inflation, That's probably the one thing that's going to give us some real ability to sleep at night in terms of, okay, when does this market regime transition occur? And it's likely to occur in and around a rhetorical pivot out of the Federal Reserve as it relates to the timing of tapering. Again, I continue to believe that that is a late July 27, 28 is their FOMC meeting. That's a late July event at the earliest. I suspect it might actually be an August or September event. We'll see. No need to make a firm call on that now, but because the market regime is still giving us reflation signals broadly. One thing we did add in this month's macro scouting report are actually we factored in our grid market backtest analysis from a covariance and volatility perspective to create a risk budget and more importantly weight the positions appropriately according to, again, the volatility and covariance of the exposures. Protocol subscribers, obviously, I'll be touching base with you guys throughout the course of the week and month. We can get to the nitty gritty on how we get to those exact weights, but this is based on the historical grid market asset backtest data in terms of relative covariance, relative volatility across these individual assets. When you put them together, these are what the appropriate weights for if you want to optimize from a vol and a covariance perspective. So we did the same thing with deflation. So separate processes. Okay, I got 30% of my assets in deflation. This is what that process is, and then I do the same process for the 70% of inflation. So again, I'm attacking both parts of the portfolio. It's almost two portfolios being merged into one from that perspective. But again, when you get to the overall pie, you have a pretty defensible portfolio that says, hey, I'm long a lot of stuff that's going to keep working if the world continues to reflate from a top-down market regime perspective. And even if it transitions to Goldilocks, most of that stuff's going to go up. And I would argue the portfolio would actually perform better in a Goldilocks because you have gold, treasury bonds, and things of that nature. Dollars really the only thing that's going to get hammered in that regard. But everything else will be melting up if that were the case. So I think we're appropriately positioned here. I think we can sleep at night if we do transition to a deleterious, i.e. deflation market regime in the near term. I think we have enough stuff like the U.S. dollar, treasury bonds, gold, the Swiss franc that'll give us the ability to sort of that'll give us the ability to get out of the other stuff without actually suffering too much of a drawdown. But I'm more concerned about missing what could potentially be a 5% move higher in stocks from here, right? Like very easily, if you transition to Goldilocks, you could see that over the next couple of months. So that to me is that will hurt a lot of institutional investors if they're underweight that and short that from a market risk perspective. So we want to call that out on slide 14. Nothing really major to call out, but the Canadian dollar is from the perspective of the portfolio construction, Canadian dollar is flashing a bearish medium-term warning signal. I hit on this in the Around the Horn Weekly, so don't want to beat a dead horse. On slide 15, what's one thing we look at to determine crowding and to sort of help us with our shorter-term risk management is the relationship between 30-day implied volatility and 30-day realized volatility. Discounts are bearish, premiums are positive or bullish. You want to be fading the market in the short term. And right now the market is super bullish on tech and bearish on treasuries. Now that something's got to give in that regard, right? Like you would expect them to be bullish on both in terms of the direction of bond yields and how they've impacted digital economy exposures in the year to date. We'll see what gives, but again, this is a shorter term signal. This is a medium term asset allocation product, so we want to make sure we're not overly reacting to that. That's what we these are the kinds of signals that we call out in the weekly Around the Horn Weeklies. But the one thing I do want to highlight on the chart on the right here is this our dispersion analysis. So every morning we refresh this. We're looking at U.S. equity sector and style factor dispersion on a month-on-month Sharpe ratio basis, and it tells you a lot about more what investors are being forced into and forced out of. If you think about investors who are what I call pod shops, the multi-manager platforms like Citadel, Millennium, Balyasny, Point72, sort of things like that. Those kinds of firms, those investors can't suffer drawdowns or they're out of there. And so the market, they're sort of constantly being forced to chase shorter term to medium term price momentum. Now, it's not to say that there aren't great investors. Some of the best investors I've ever spoken to are sitting in those seats. And in fact, I think it's quite frankly, those are the hardest seats to sit in and stay in over the course of a buy side career. So I have a lot of respect for those investors. But again, this is just kind of the nature of the beast. People have to chase things at the top of the chart and they have to sell the things at the bottom of the chart. Otherwise, if they don't, then they tend to not stay in the seat. And so one thing I wanted to call out is that if you look at the composition sectors and style factors at the top of the chart, it is nowhere near screaming something that it looks like a big market move is about to happen to the downside. You're talking about high debt, energy, high beta, financials, like that stuff's got to go if we're talking about we're heading into a real meaningful market decline. And so again, that gives me a lot of confidence to say, okay, maybe we got another month or two of reflation left, or maybe even a potential market regime transition to Goldilocks. That would even be more positive for risk assets, and really, really make the sell in May and go away community very wrong on that view. Getting into the bottom up macro regime outlook on slide 16 here. So this is our US grid outlook. We're still in reflation, but as the first row shows, we're likely to transition to deflation by the midsummer. Now, when I say deflation, let me be very clear. We're not going to negative inflation. We're not going to negative GDP growth. All we're saying is we're using the word deflation to categorize the state of the economy whereby growth and inflation are slowing simultaneously. Again, that's all we really mean by that. There could be deep deflations, obviously, at the bottom left of the chart. You had April and May of 2020. But you can have very light deflation as well, as in terms of what we're projecting, kind of for this go round. So, those have different market implications. Obviously, when you slam into a deep deflation, markets tend to crash. But when you're kind of marginally decelerating into deflation, in fact, it actually has historically been bullish for risk assets. So in terms of the U.S. economic outlook, I mentioned this in my Real Vision video last week. I'm less concerned about the economy going into deflation than I am about the market regime going into deflation, just given a lot of the drivers of this sort of, everything bubble really are really going to start to come unglued. And really, you're going to lose a lot of the drivers, 3-4 months from now, they'll all be gone. And so that to me is the real market risk. I'm much more concerned about the market risk than I am about the economic risk. And that's the opposite of what I would have said, maybe, 18 months ago. On slide 17, U.S. growth, secular view, cyclical view. I mentioned U.S. growth on the right chart on the right there is decelerating modestly over the intermediate term. So nothing to be overly concerned about. On slide 18, just showing our agent-based nowcast model still gathering momentum for the data that we're getting in May, although we are rolling off the cycle peak. If you can look at the April column, it's more green than some of the data that are starting to roll in from May, and that's precisely what we would expect. That's precisely what we did expect. On slide 19, U.S. economic surprises, they could actually turn persistently negative in a couple of months. And the reason I say that is that, going back to slide 18, or slide 17 rather, you have this very, modest deceleration off the cycle peak and growth. And what that's likely to do is keep growth expectations elevated. And if growth expectations stay elevated, but you're still decelerating on a rate of change basis, that's likely to catalyze just a persistent series of negative economic surprises, because it means, and the modest deceleration means economists and analysts, they're not going to have enough data, at least not until it's too late to take down their numbers, right? So their numbers will just be elevated in the back half of the year. We're just going to be coming in lower and lower from the top down, sort of economic release perspective, but also from a bottom up earnings release perspective as well. I mean, the economists and the analysts at these banks are talking to each other. They're reading each other's research. It's an incestuous process in that regard. So I would expect the back half of the year to be really characterized by a couple of Ds, or a few Ds rather. You got deflation from a macro regime perspective. You have disappointment from an economic release and earnings season perspective, and then you have a delayed Federal response policy reaction, Federal Reserve policy reaction function, right? Like historically, they would have tightened too soon. They probably would have pivoted already, but we expect them to pivot. We expect Jay Powell to make due on his promise and not tighten prematurely. So that likely delays any rhetorical pivot towards tapering into the second half of the year. On slide 20, I mentioned this, but earnings expectations are elevated, and we're not going to slow fast enough for economists and analysts to take down their numbers. So that means we're set up for second half of the year that's going to be pretty disappointing in my perspective. At least on an ex-ante basis, that's my expectation. It's like everything is at perfection from an expectations perspective, but then once you lose the rate of change that people aren't measuring as mapping as dutiful as we are, then that's what's going to catalyze that sort of, oh man, the data's not as good as I thought it was. And it's not as good as I thought it was a month later. And again, you're not slowing fast enough for people to take down these numbers here on slide 20. On slide 21, getting into our U.S. inflation outlook. So obviously, very elevated from a secular perspective. We have been making a series of lower highs, but we've clearly broken that trend to the upside. From a cyclical perspective, we have inflation peaking in May and inflecting and rolling off and decelerating over the next 12 months. Which is our forecast horizon. But the reality is we're going to stay very elevated. It's, there's a lot of sort of cyclical inflationary pressure in the economy. There's a lot of one-off inflationary pressure in the economy, and the confluence of that is sort of combining to say, hey, look, no, we're going to decelerate, but it's going to stay high and sticky. And so that's very unlike previous cycles. If you can just look at the chart, you typically roll off much faster after these cycle peaks. So that carries with it a different set of implications as well. It's kind of like the late 90s almost, if you look at the chart on the left. Slide 22, looking at our inflation nowcast model. So, again, it's kind of very similar to what we saw in the growth nowcast model, where, April, May is really the peak. And certainly by the time we're in July, August, it'll be very clear that those were the greenest columns in these tables. So brace yourselves for that. On slide 23, owner's equivalent rent will likely keep an elevated floor under US CPI, even as inflation trends lower in the second half of the year. And what I mean by that, and this is something I've been talking about since November, whenever you had, historically speaking, whenever you had meaningful accelerations in home prices, and you get to a certain spread in the relationship between home price appreciation and owner's equivalent rent, it is historically presaged massive accelerations in owner's equivalent rent. Now, why is that? Well, at some point, the affordability calculus for people, human beings, just gets asymmetrically skewed towards renting. I'm sure everyone who, if they could afford a home, would buy a home. But again, you price people out of the market, and then it forces people into rental demand. And so that's historically what we're seeing. And I don't want to pat myself on the back too much, but I literally said back in November, I think owner's equivalent rent's going to bottom in February and inflect higher. And I was a month off on that. It bottomed in March and inflected higher, but it's going higher. And it's over the next 12 to 18 months, that red line on the top chart is going to be a lot higher than 2%. So brace yourselves for that. So that's going to be working against, in terms of keeping inflation cyclically elevated. You have a lot of you have a lot of different categories trending lower over the next 12 months. But this is one big thing. If you think about shelter CPI, is 33% of the overall index. Owner's equivalent rent is about 3/4 of that. So, you're talking about, 27%, 28% of CPI is OER. This will keep inflation elevated, even though the rest of the categories are decelerating on a trending basis over the next 12 months, post peaking in May, obviously. On slide 24, you get the fastest rate of change in core PCE ever. So looking at that on a month-on-month delta basis, we accelerated 112 basis points to 3.1% year over year. That's the fastest rate of change ever. But on slide 25, workers don't have that pricing power, that's endemic, that businesses obviously are demonstrating with that acceleration. We're still seeing average hourly earnings for private sector wages, those are down at 2.4% on a year-over-year basis. Now, part of that, you have all the mix shifts in labor demand, this and that, and this and that. But, from anecdotally speaking, it's pretty clear that firms have not, really budged yet on actually, paying to get people off the couch, off collecting, free money from the government and back into the labor force. So that's something that could change, but for now, it has not changed. On slide 26, one thing that's pretty interesting right now, and I think it was very instructive on May 13th. You go back to May 13th, I feel like I was one of the few people saying, hey, no, we're still in inflation. This is a great opportunity to buy dips in equities, reflation equities and commodities. Because again, you got this all-time high inflation surprise. And again, I'm not the kind of person who likes to, short charts because they're high on the page. But again, this is an all-time high and like an unsustainable high. And our bottom-up inflation forecasts are saying inflation's peaking here in May. I suspect that blue line is likely to mean revert over the next 12 months. So if you're betting on, you don't want to be the Johnny come lately on the trade, but obviously we're still, 70% of the assets are in reflation. So we're taking advantage of this. We've been taking advantage of this since going back to early November. But again, it'll end at some point. And so we want to be very careful about, the things that we're starting to orient that portfolio towards to give ourselves some real cushion to get out when the market regime does start to transition. In slide 27, looking at global grid outlook. So there's room for an upside surprise in June. I think that I is most likely to be an R, just given some of the dynamics we're seeing in Europe and in EM from a COVID response perspective. So I wouldn't be overly concerned about that I in June, but I will be overly concerned about the D's in July and August and September and October, because again, I think they're just from a base effects perspective, it's going to be very impossible not to demonstrate deceleration in growth and inflation throughout that time period. So there's something that the market is eventually going to price in, but when the market prices that in, it's likely again a function of Federal Reserve policy reaction function, a function of fiscal policy dynamics, a function of a lot of different things that we're going to keep tabs on. On slide 28, Just looking at global growth from a cyclical and secular perspective, very similar dynamics as it relates to a modest deceleration off the cycle peak throughout the, kind of the next, few quarters. So that's something to call out on slide 29. Just looking at our agent-based nowcast model for global growth, nothing material to call out, but again, you're seeing what I mentioned. You get at least in the data points that have been reported through May. You have the PMI data and the business confidence data as well. It's still accelerating. Like it's the greenest of the greenest of the green is in the May column. So that's what gives me confidence that you could see an upside surprise in terms of the trend not inflecting in June. So that we'll see that when the data is reported. On slide 30. Global inflation, secular and cyclical view. So, when you model inflation from a bottom-up perspective, looking at the agent-based nowcast model and the things that the dynamics therein, inflation is likely to peak and roll pretty sharply. But then when you look at it from a stationary mean reversion perspective, it could stay cyclically elevated. So I think the global inflation outlook is much more confusing from here, than it is. The range of probable outcomes is significantly wider from here than it is for U.S. inflation. And you have like China doing its own thing, yet Europe, different countries in Europe doing their own thing. So I think that's why you're seeing part of that dispersion. Again, these aren't deterministic models; these are stochastic models. I'm just reporting what the stochastic models are telling me to tell you. On slide 31, there's our agent-based nowcast model for global inflation, kind of seeing similar dynamics as it relates to the U.S. inflation. You're seeing some roll off in some of the features in May, but again, still extremely elevated. We're not going to really see a material change in the trend until you get the July, August columns in these tables. On slide 32, looking at global growth from a top-down perspective, looking at all the countries we maintain stationary mean reversion models for, we maintain agent-based nowcast models for. It's all the same models, just different countries, different economic data sets. So that makes the world pretty easy to measure and map from the regime segmentation perspective. But just looking at the projections, just kind of looking at the columns and the greenness and the not so greenness of the columns, it's like June, you won't really notice that we're decelerating. July, maybe you notice, but certainly by August, it'll look a lot different in color coding terms than it does in May and it does in June. And so that, again, we expect like sometime between mid-July, late July and late August, it's sometime, certainly by September, we would expect the market regime transition to occur. But, if we're lucky, it happens in late August and we got a couple more months of paying, of really earning, really outperforming as a function of staying long, a lot of things that can work in deflation and or Goldilocks. And if it isn't, we'll have to pivot sooner in accordance with the market regime transition process. So, we're ready for it all. We're going to wake up and do the same thing every day. And then if the market gods give us more mana from the heavens on the long side of inflation assets and maybe even Goldilocks, great. If they don't, then we know what to do. The process works in every direction. On slide 33, global inflation just looks a lot different than the prior table. Inflation is likely to be sticky throughout our next 12-month forecast horizon. Now, again, these are the median projections. So going back to those charts that I've been highlighting, these are the purple lines. The light blue line is the stationary mean reversion model. The dark blue line is the agent-based nowcast model. And then you have the purple line, which is the median of those two lines. And so the median is telling you that the world is going to feel inflationary for a while from a year-over-year rate of change perspective. Now, again, that doesn't mean the trend is positive. The negative delta, the trending negative deltas by the time you get in July and August is what's contributing to the D's that you're going to see on the chart on slide 35. Skipping ahead, you look at it, slide 35. Like the world was in this we were on dry land for a really long time. It was just awesome. You can be long a lot of stuff from the lows of last spring to now, and then eventually you're just going to be back dipped into the water. And so again, when does the market care about being in that water? Can the market swim from this dry land to the dry land we're going to start to see in the spring of next year? We'll see. I don't suspect we're going to survive it without taking a real deep bath, though. So that's something we'll call out. We'll call that out as we progress throughout the deck. Skipping ahead to slide 36 here. U.S. exceptionalism is peaked, going back to the global grid outlook. U.S. These are city economic surprise indices. The dark blue line is the U.S. Obviously, we're making a series of lower highs here. Japan and the Eurozone are actually, kind of taking the baton and don't look now. But EM, the green line, is actually bouncing and recovering. And this is exactly what you would expect, right? The people who handled COVID the best, i.e., China and the U.S., from a vaccination and lockdown and just getting everything in the stimulus perspective, pick from those perspectives, those economies have, now they're kind of, they were the leaders, but then now they're the laggards, right? That's kind of the key point here is that, okay, now the laggards are at the top of the chart now, particularly the big move we're seeing in Japan as well. So I would expect EM to continue to catch up as well as COVID dynamics there continue to improve. When you look at it from a bottom-up perspective on slide 37, U.S. exceptionalism has peaked as well. So again, the top-down, the city economic surprises are saying U.S. exceptionalism has peaked. But then when you look at it from a bottom-up perspective, so what I'm showing here is the next 12-month earnings estimates for the MSCI USA index relative to the MSCI all country world, excluding the U.S. index. So taking the spread between those earnings, or it's not the spread, the ratio between those earnings expectations, and clearly the ratio peaked in the early part of this year. We're now decelerating on a trending basis. Very similar to what we saw in 08, 07, or kind of 06 to 07, similar to what we saw like 09 to 11. So this is something I want to call out. These things could last. I mean, even in 2016, 2017, that was like 5 quarters of global outperformance. So this is something that investors should brace themselves for, particularly to the extent that we do stay in reflation or transition to Goldilocks for a couple of months. Like U.S. will get smoked relative to global equities. EM in particular. Again, it's who's coming out of the hole last, who has the upside from an earnings revision perspective in the context of this chart. On slide 38, looking at our China grid outlook. So that's bouncing back and forth between inflation and deflation. We had been bearish on China, but we actually, I would argue I'm probably neutral on China because again, you had a couple of catalysts that are positive. On July 1, we have the 100th anniversary of the Communist Party, the CPC, the Communist Party there. And then, again, the most important reason the reason I'm saying that is because our volatility adjusted momentum signal broke to bullish on China a few weeks ago. And so why did it go from bearish to bullish? I mean, I feel like the bearish move priced in the I's and D's, and now it's got the market's looking forward into some other catalyst, and I don't see G's and R's on the top row that are close enough for me to think that the market is really moving to price that in. So to me, I think there's probably something political that's driving that, because again, policy matters. It's hard to forecast, so we don't spend a ton of time on trying to handicap it, but policy does matter, so we want to call that out. But again, we're neither long nor short China, so I don't know why I spend so much time explaining that, but a lot of you care about China, so I want to make sure we hit on that. On slide 39, as I mentioned, China kind of is moving past its peak rate of deceleration. It's still likely to decelerate again. The whole world is kind of in this rolling past the kind of the best of times into the worst of times. Pick your country, but China is actually likely to be decelerating on a trending basis into the spring of next year as well. On slide 40, looking at the Chinese agent-based nowcast model, very clear that Chinese growth peaked in the winter and is clearly starting to decelerate. Just looking at the color coding across the features of the nowcast there. On slide 41, you look at China's credit impulse. That's trending lower, and so I get a lot of questions from investors like, "Okay, you long inflation assets, but your model's bearish from China." Well, yeah, that's true, but you look at something like the Chinese credit impulse. The commodity cycle is somewhat tethered to it, but it's actually lags the Chinese credit impulse. Like you look at when commodities have historically peaked in the last kind of 15, 20 years, it's always been well after the inflection points in the Chinese credit impulse. So that gives me confidence that again, Chinese credit impulse is still obviously rolling over here in terms of the latest data, but that just in terms of the these charts, you got 6 to 12 months of upside in commodities historically from these points. So I definitely want to call that out because again, it just we don't do narrative macro here. We do data driven macro. Everything I say, do, send out, type is based on a time series. If there is no time series, it does not come out of my mouth. It does not make it into these decks. On slide 42, you look at liquidity dynamics in the mainland. They're actually suggested that Chinese credit cycle may inflect higher by Q4 in terms of the historical kind of lead lag times in these relationships. So I'm looking at 3-month Shibor in the blue line relative to the China credit impulse in the red line. And 3-month Shibor is a great proxy for sort of the impact of liquidity provision in the PBOC. I spent a lot of time building models to track PBOC liquidity provision, the various policy channels, and the reality is all you really need to do I've learned this in my old age, all you really need to track is what 3-month Shibor is doing. And the reason I say that is that over 80% of private non-financial sector credit in the mainland is on bank balance sheet. So if you get interbank rates right, you're probably going to get, the pace and of credit intermediation right. So that's something to call out. And so the fact that the blue line is really inflected and is continuing to trend lower implies that we're likely to see a bottom on the red line in a few quarters. So that's something I wanted to call out. But again, nothing to do today on that. I just want to call it out because it's an important dynamic. On slide 43, you're trying to get commodities right. The number 1, 2, 3, 4, 5 thing to get right is the US dollar. It's pretty evident in this chart, particularly from, kind of the mid to late 90s. Like, it's just been a dollar trade. And the reason I believe, again, this is where my kind of thinking hat comes on. The reason I believe that the correlation really started to accelerate in the mid to late 90s is really just a function of the financialization of commodity markets. You went from, consumers of commodities and businesses, producers of commodities, really dominating asset markets to speculators really dominating asset markets. I think the last time I saw this, and please fact check me on this, I love when people correct me and give me information because I want to learn. I think crude oil is like 40 times financialized, like the amount of futures and options market activity in the crude oil market is like 40 times underlying demand. And this is the most demanded commodity in the world. So that tells you that, like, you got to get these dollar liquidity cycles right if you actually want to get the direction of commodity prices right. It's not a supply and demand thing. I know it sounds cool to build a supply and demand model and talk about mines here and talk about, transportation there and talk about cost curves, and that stuff's very important. Like, if you're trying to get the long-term view right, but if you're trying to get like a 6-month macro trade right, you're trying to appropriately time a macro regime phase transition, none of that stuff matters. I'm sorry to tell you, but I've been doing this for a really long time. Trust me, in that, you look at this 09 column here, when I started on the firm, when I first started, I built a lot of nonsensical models about forecasting weather to get ag right. And guess how often those models were predictive? Never. And so again, if you're trying to get commodities right, get the blue line right. In slide 44, you look at the Chinese inflation secular view. So like, they haven't broken out of the persistent disinflation, deflation they've been in. Our model has Chinese inflation sort of basically, accelerating a little bit from here and then kind of trading sideways. Now, this to me would be one of the more inflationary things we see. And part of this is, China did it to itself in terms of allowing so much renminbi strength in the last 12 to 18 months. So, this is probably why the lines look like that in terms of the projections. If we get that red line, if those projections are wrong and like need to just get revised up by 50 to 100 basis points, that'll be very inflationary for the rest of the world. I don't think that's going to happen. In the global bond market, I think would sniff that out across supply chains and really China's impact on that. But that's something that, from a risk perspective, I think that could actually be very painful on the long side of bonds and gold, because that would actually create an upside surprise in bond yields. But again, the model is what the model is. I'm telling you how it could potentially be wrong, but I don't wake up expecting to be wrong. The model's based on that. On slide 45, just highlighting our China nowcast model. You're still seeing inflation accelerate on a trend basis across the many of the features, but again, April is the peak. So in terms of that, gives me confidence that May is likely to show, or not May, but once you get into June, July, and July in particular, that's when you're going to start to see the inflection, and then from there, it's likely to be back and forth between in deflation and inflation from a China grid outlook perspective. On slide 46, getting into Europe. So we got our Eurozone grid outlook. Our models are basically projecting a classic clockwise macro regime cycle. All right, we go from Goldilocks to reflation to inflation to deflation back to Goldilocks. Like, this is what should happen, right? If you think about how the world actually works in year-over-year rate of change terms, like, you go to Goldilocks at the bottom of the economic cycle, and then you start to accelerate and supply tightens and you get more inflation, and then supply tightens too much and you run out of productive capacity in terms of labor and capital. And then you start to decelerate from a growth perspective. And then boom, you go into recession at some point after policymakers have tightened a response. And then boom, you go back into Goldilocks after they've eased in response to the tightening. And that's how the economic cycle in theory works. Now, again, these are monthly dots on the chart. So, you're not going to do this every 4 months. Clearly it takes about, a couple of years, 2 to 3 years. The periodicity on average is about, 2 to 3 years in the US, it's about, maybe 3 to 4 years in other countries. But the reality is, it could be anything. I don't care what the historical periodicity is. I care what the pending periodicity is. And we're using things like base effects and agent-based nowcast models to give us a very data-driven, very accurate, perspective view on that. And if the data tells us to do something different, if the data tells me to expect something different, that's what we'll do. But for now, these are the modal outcomes of our lives. So we respect those and we invest accordingly. On slide 47, again, every country kind of looks the same from a growth perspective. You know, you're accelerating. Actually, Europe actually, from a convexity perspective, actually it did accelerate in April, and I would expect it to peak in May or peak in maybe even in June, depending on what we're seeing from a COVID response perspective. But again, you know, in terms of like the major economies, you know, U.S., world, China, Europe that we're highlighting in the deck, Europe to me has the most potential to sustain an acceleration in growth into the early part of the summer, and so that gives me, you know, confidence in some of our European longs. We're long Denmark and Sweden in the portfolio construction. Slide 48, you know, I mentioned this is what I mean. You look at the far right column, it's the darkest green data. Like we're still accelerating in May, whereas if you look at the U.S. nowcast model or the China nowcast model, like it's like, all right, April was clearly the best. It was March for China, and then obviously May. You know, I'm not saying May is or is not the best, but it's certainly in terms of the data that's been reported thus far here in Europe on slide 48, this is the best data we've seen. So we have to respect that. On slide 49, looking at European inflation. So still making lower highs from a secular perspective, but cyclically obviously getting very elevated, you know, likely to continue accelerating at least to the latter part of the summer. And so that's something we wanted to call out. But, you know, maybe it does, maybe it doesn't. But the reality is, you know, this is why German bond yields look a lot different than the U.S. Treasury yields, right? Like the U.S. inflation curve is peaking and rolling now, whereas the European inflation curve has a little bit more upside into the later part of the summer. So that's something to call out. On slide 50, you know, very similar dynamic in the Eurozone growth nowcast model. Our Eurozone inflation nowcast model is kind of sending similar signals in terms of, you know, just deeper, darker green in the columns. Like, you know, like I can spend 5 minutes reading down, you know, all the different weights. You know, these are dynamically retrained monthly according to the relative strength of their first difference regressions. And the reality is, like, the whole point of this process is to make it very simple. You know, I'm doing the work and the number crunching so you guys can simplistically execute what the number crunching implies. So look at the colors. That's all you really need to know. If the colors are getting more green or more red, that's what's happening in the economy. I wouldn't make it more complicated than that. On slide 51, you know, transitioning to our cyclical and secular forces framework, starting with demographics on the secular side. You know, there's still disinflationary across the developed world. What I'm showing here on the x-axis is the 5-year forward old age dependency ratio. The y-axis shows the working age population on a 5-year forward CAGR basis. And you know, you're just saying, you look at the bottom of the chart there, it's like the world, like this didn't change. Like, you know, we have all these complications and dynamics stemming from COVID, but none of this changed. So this is the backdrop from an inflation perspective that we have to, you know, kind of respect and keep in mind. Again, 5-year forward, not 5-year backwards, 5-year forward dependency ratio, 5-year forward working age population growth. This is where the world is still headed. So we want to keep that in mind. On slide 52, the secular drivers of disinflation are still intact as well. You're looking at money velocity relative to the labor force participation rate. It's like, yeah, duh, no wonder we had so much disinflation in the last couple of decades. This is why. On slide 53, you look at corporate America, you know, they continue to be dominated by monopsonies and broad-based preference for CapEx over labor. So the blue line is showing the market cap of the S&P 100 index, the mega cap index, relative to the S&P 500 market cap. And so we went from, you know, I don't know, 54, you know, the low 50s in 05 to, you know, basically 66, 67% here in 2021. You know, so it's effectively, that's a proxy for monopsony in you know, the monopsony and industry concentration in the U.S. economy. And then you look at, you know, looking at from the data from the national count data we get from the BEA, you look at the ratio of the compensation, employee compensation relative to the ratio of consumption of fixed capital. And obviously it's plummeted and hasn't recovered, you know, since the Great Recession. You know, that's why we call it the jobless recovery. People just, you know, they're not being hired, they're not getting paid. And it kind of really hasn't changed. It's changed a little bit in the last, you know, couple of quarters. But, you know, again, it's a you know, post lows bounce, but not a real recovery back to where we were in 2000, you know, early parts of 2000. So, you know, this, if you want a chart to look at, okay, like why has there been persistent disinflating wage growth? This is it. Monopsonies and business decisions to buy machines over people. That's as simple as it is. I'm going to make it more complicated than that. On slide 54, looking at balance of payments from a secular perspective. So this is a really interesting chart. The x-axis shows the current account balance as a percent of GDP. The y-axis shows the sovereign fiscal balance as a percent of GDP, and the U.S. dot is down there all by its lonesome. It's got a buddy in Brazil, maybe a cousin in the U.K., but it's down there by itself, really. Kind of in terms of its fiscal balance and the current account deficit. And the reason I flag this, and the reason I demonstrate the analysis this way, is okay. We're in the bottom left of this chart. The rest of the world has to finance your budget deficits. Either the rest of the world does, or your central bank does. And if your central bank does, historically, that's been very, very currency negative. So this is the kind of backdrop for the dollar. Like this is the starting place to have a discussion about, should the dollar go up or should the dollar go down? Now, there's a lot of factors that impact the dollar, both from a euro dollar system perspective, both from a terms of trade perspective, from a capital account perspective. But to me, this is like the starting point. Should there be more dollars being printed, and who's printing them and who's paying for them, or should there be less? And obviously, more is the answer here on slide 55. And the reason we call that out is because that obviously augurs for a really negative dollar cycle long term. We're coming off a very asymmetric high in the broad trade weighted dollar index. This on the black line here is showing the Bloomberg dollar index, but it's obviously a similar chart. And what the blue line shows is the MSCI USA index's exposure to the digital economy. So I'm adding the percent of market cap that is allocated to tech and communication services stocks, and then the red line shows the percent of market cap that's the exposure to the real economy through the lens of energy, financials, industrials, materials, and real estate stocks. And so the blue line, if you look at where the blue line is relative to where it could go when the dollar is really low, it can go down a lot from here, and obviously the red line can go up a lot from here. The reason I put these analyses together, looking at through the lens of the dollar, which again we're bearish on longer term, I think if the dollar goes down a lot, it makes a lot of sense why the blue line goes down a lot with it. If the dollar goes down a lot, it's more nominal GDP to spread around. Like Jeff Snyder will tell you that it's just more nominal GDP to spread around. So the economies and businesses that benefit from more nominal GDP get more market cap as a ratio to the rest of the index. And when there's not as much nominal GDP to go around, i.e. in the last decade, then the guys who can create their own GDP, like the big tech and comm services companies, they get the premium multiples and all the market cap. So these are big cycles. I basically spent most of my career in a I guess the first third of my career in a dollar bear market, but certainly the second 2/3 of my career in a dollar bull market. And if you're in the mid 30s or below as an investor, all you really know is buying what they call in Boston high quality compounders, and that's gotten you paid. But that's not going to get you paid if that black line is headed a lot lower over the next 3 to 5 years. What's going to get you paid is an acknowledgement that this stuff is cyclical. These are longer term cycles, but it's cyclical. And at some point, 3 to 5 years from now, I would expect that red line to be up back to where it was in the mid to late 2000s. If the black line is where I expect it to be. So keep this chart in your head as well. On slide 56, maybe we're there. Maybe we're already kind of starting to get there, right? You look at the ratio of cyclicals to defensives, and it definitely is suggestive that we may have already undergone this phase transition from a secular market regime perspective. So the red line shows the Russell 1000 defensive index relative to the Russell 1000 dynamic index. And obviously it's below 1 now. We've broken the buck, I guess, so to speak, in that regard. And then you look at the Fed broad trade weighted nominal dollar index. This is actually probably a better chart to explain the dynamics that I'm highlighting, that I just spent the last couple of minutes highlighting. If this blue line is going back to where the blue line was, like in 2011 or 2008, like we're already low from the perspective of the red line. So are we going back to like the low 70s where we were in 2000? Like to me, that is a meaningful asset allocation, like long-term thing to keep burning to the back of your mind. If you got to have a view on where the dollar is going over the next 3 to 5 years. If you're an equity investor, if you're a credit investor, obviously us macro guys, this is like the number one thing we wake up thinking about every day. So it's not new to us. But if you're putting equity risk on or credit risk on, you got to have a view on the dollar from here, because again, we're already broken the buck from the perspective of the types of businesses that benefit from a strong dollar and the types of businesses that benefit from a weak dollar. So if the dollar goes down a lot from here, we're talking about going all the way back to where we were, back to where we were in the late 90s, right? Like that to me is something that's really important to keep in mind. That red line, again, it burn these charts 55 and 56 in the back of your head, as it relates to the next 3 to 5 years and the types of businesses you want to buy dips in and the types of businesses you want to sell rips in. To be clear, we expect the blue line to be down a lot lower 3 to 5 years from now. So that obviously augurs towards, getting out of digital economy businesses at the margins, and into making room in your portfolio for real economy businesses to outperform in a higher nominal GDP regime. That's all we're trying to say. Doesn't mean you can put that on today or do it all today, do it all tomorrow. It's just how you orient yourself over the next 3 to 5 years. On slide 57, looking at leverage. In line with past cycles, extend and pretend was the global policy response to the COVID crisis as well. One thing we look at to track leverage is we look at private non-financial sector credit to GDP ratios on a 3-year Z-score basis. On the y-axis, we show the private non-financial sector debt service ratio on 3-year Z-score basis as well, to normalize it and get all these countries on the chart. And, all the countries are to the right of the chart, right? Most of them. And so that implies they all basically said, no, we're going to cut rates and do QE and force you to take on debt to sort of, paper over, to get to the other side of the crisis. And, I'm not saying it was good or bad policy. I'm just telling you this is the setup now. And so, going forward, so how does the world, deal with this leverage that it's accumulated? If we see some premature tightening, it's going to blow up, obviously, large parts of the world, particularly Europe and Asia. I suspect Lagarde is well aware of that and is not going to do that. But again, if, one positive thing that can happen, you obviously can grow your way out of debt as well. So that's certainly what's happened in the last, couple of months. That these data are lagged by a couple of quarters out of the BIS, but certainly some of the best data sets out there and publicly available data sets out there that I like to keep track on. On slide 58, so in terms of leverage, like potentially being a bugaboo as you get into a deceleration, like when growth's accelerating, leverage is fine. You want more. When growth's decelerating, leverage is your worst enemy. So I think investors are starting to get on edge because when you look at kind of the market analog, so this is the 2009 analog. The blue line is the 2009 S&P. The red line is the S&P from February 2020 to now. And we're kind of getting into like uncomfortable territory in terms of like when do we expect this big correction to come? And right around, and it's kind of similar to the growth dynamics as well. You look at the bottom panel on the chart showing the OECD composite leading index for the U.S. That's kind of like this time period is kind of like when it inflected as well. So like this is we're in uncharted territory from a market risk perspective, from an economic perspective, from a policy perspective. So people feel uncomfortable, and naturally, a lot of people rush to sell and buy away to sort of hedge that discomfort. But the reality is, if we do reflation for another 2 months or Goldilocks for 2 months, that's going to make you very wrong because that red line is going to be way higher on the chart. So just keep that in mind here on slide 58. On slide 59. From a medium-term perspective, though, again, I mentioned, I don't want to sound like I'm talking out of both sides of my mouth. To be very clear, we expect reflation to remain the dominant market regime through at least June, likely through July. If we do see a market regime transition in the next 1 to 2 months, it's most likely going to be to Goldilocks. And then by the time you get into August, September, that's when we expect deflation as a market regime to really take hold and kind of, create some drawdown risk. So let me be very clear about that. But going back to this chart here on slide 59, Bitcoin has been leading some of these drawdowns over the last, kind of 5 years or so. Not all of them, but certainly the black dotted lines are where you've seen Bitcoin peak just ahead of stocks and a big drawdown in stocks. So obviously Bitcoin peaked in April, and so we'll see how much longer stocks can diverge, or maybe even Bitcoin finishes consolidating and breaks out to a new high. I don't know if I have a view there. It's neutral in our volatility just on the minimum single basis. I just as soon stay away because, again, we don't know enough about this asset class to understand how it deals with these types of weird, funky dynamics from a policy perspective as well. So I'd rather just go with what I know. And obviously we took out Ethereum as well. So that's something to highlight as well. But, we could be wrong in that. If we go to Goldilocks, Bitcoin and Ethereum are going to go up. I guarantee you. So that's something to keep in mind. On slide 60, this chart, if there's something that keeps me up at night in this deck, it's definitely this chart. And this is what I'm showing here is the real earnings yield. And that's sending a bearish long-term warning signal to equity investors. So the red line is just the S&P 500. The blue line, however, is the S&P 500 earnings yield deflated by US CPI. So just, whatever US CPI is reported at that time. And we look at, historically speaking, and this is, 50, 60 years of data, whenever we've seen the blue line go negative, it was either during or just ahead of a major drawdown in stocks. Like, to me, I'm like, is there one where it didn't? Yeah, there's the kind of the early 70s is like the only one where it wasn't ahead of a major drawdown in stocks, right? Like to me, like it's yeah, this chart should keep everybody up at night. Like look at where we are now, minus 80 basis points. Like look at where the red line is, right? Like we're in no man's land from that perspective. So I think investors need to be concerned about this for sure. If you look at like the next 1 to 2 years and like could we see a 30-40% drawdown in stocks from this level? Not saying it's going to happen, but certainly if this chart would imply, something has to give in that regard. So again, this is definitely something to keep in mind. But again, you got to be able to separate the cyclical from the secular. You have to be able to say, okay, I'm bearish starting in August and put that exposure on, but I'm bullish for now. I want to stay with these exposures. You use macro to time markets. That's the only reason you should have macro and macro overlay in your investments. If you're a good stock picker or a good credit picker, why are you listening to macro risk managers? Oh, yes, it's because we help you time market regime cycles. When the market regime cycle transitions to something bearish, I'll be extremely loud and clear about that. And I'll probably put this chart closer to the front of the deck. But for now, it's closer to the back of the deck because, again, I don't think it's something we need to worry about today. It's just something to keep in the back of your minds. On slide 61, you guys remember this? I definitely do. Probably the first major call that I contributed to in my prior shop. This was sell the main, go away in 2010. We had a 16% correction in stocks, and that's probably about what you could see in the second half of this year as it relates to the U.S. and global economies transitioning to deflation, albeit modestly, which is historically been positive. But again, I mentioned I'm not worried about the economy. I'm worried about the market risk. The market risk associated with disappointing earnings, disappointing economic data, a delayed policy reaction function out of the Fed that causes it to tighten well into a slowdown as opposed to right at the precipice. So I think you could see some market risk in the back half of the year. Again, going back to the earnings yield slide from the prior slide, the real earnings yield, obviously stocks are extremely overvalued from that perspective. So again, this is where you get market risk, conflated. You don't want to conflate market risk with macro risk. Sometimes macro risk causes the market risk, i.e. last spring, when you go into deep deflation, bottom left of those grid charts, that's what causes the market risk. But sometimes the market risk is really just complementing the economic risk as well. So this is one of those times. On slide 62, Jay Powell definitely remembers the spring of 2010, the summer of 2010. You go back to March of 2010, the Fed ended QE1 prematurely. Well, they were preset end dates. So I think they learned their lesson with QE3, did not do that. And then you go back to June of 2011, they ended QE2. And then right after those programs ended, as you see by the black dotted lines, we had a massive tightening in financial conditions, right? Like, so this is what I think this is the number one thing that Jay Powell is worried about is prematurely tightening financial conditions, right? They prematurely tightened financial conditions in 2018 as well, right? Like the market, we weren't close to neutral from a what was that wonky word? Labor force unemployment. NAIRU, non-accelerating inflation unemployment rate. Man, these guys need to quit it with all this stuff. Anyway, yeah, I digress, Mr. R Star. On slide 62 here. So again, go back to slide 62. Then this is to me is the number one reason why the Fed is easy money, even though the chart of the SPY and the chart of commodities look like they do. It's because they don't want to do a repeat of 2010 and a repeat of 2011. Jay Powell's a buy-siders worth 50 to 100 million bucks. Guy's no dummy. I think he gets the joke, even on his own premature policy tightening mistake. On slide 63, this is the chart of all in macro. If you need one chart to figure out what the heck to do, this is it. This is G4 central bank balance sheet, the red line relative to the world equity market cap. So again, we all want to figure out when that red line is peaking and rolling so we can get out of the blue line. And we're using economic data. We're using our forecast to predict that. But ultimately, part of it is inherently unpredictable, particularly if you think about the Fed. They have a new framework. They have an asymmetric inflation targeting framework that's new. They have a labor market shortfall framework that's new. We don't know how much data they need to see before they have to start saying things differently in and around these FOMC meetings. I have no idea. I said it maybe July at the absolute earliest, because that'll give them several months of potentially hot inflation and unemployment data or employment data, but where their employment data is not even corroborating. So again, that's something to keep in mind. You have labor surprise indices are at cyclical lows in terms of the U.S. So that's something to call out. On slide 64, love talking about this. This is one of my favorite charts. on the macro. This is how I contextualize political risk, and I do that through the lens of the Gini coefficient on the x-axis, and on the y-axis is the headline unemployment rate. And you put those two factors together, what I would consider to be the drivers of populism. It basically suggests that the U.S. is an emerging market now from a political risk perspective. Like we've separated from the pack, like where all the developed market economies are in Europe and Japan. And now we're out hanging out with like China, Russia, Brazil, Mexico, from the perspective of income inequality, which is the Gini coefficient measures, and the drawdown in our labor market. I mean, this is why populism is bipartisan in the U.S. Trump proved that you can be populist as a Republican. Biden is obviously proving that the Democrats are happy to engage in those types of policies as well. So this to me is why we've jumped the shark from a fiscal policy perspective. I mentioned this on my Real Vision video. It's not about like $1 trillion deficit or $500 billion deficit. It's trillion or 3 trillion. Like that and the reason for that shark jumping is because, again, Donald Trump pulled a decent chunk of the Republican Party over towards the left. And obviously the Democrats have been moving that direction for quite some time now. So again, this is why you're seeing the big guns and the big dollar amounts and the big headline figures. And obviously you're going to have core parts of the GOP fight back. But at the end of the day, they could be fighting a losing battle. If the population wants big checks from the government or certainty from the government from an economic perspective, which is obviously what Trump was constantly promising, then they're going to continue to vote for politicians who promise them those things. Now that they know that they can actually, use their votes to get it. On slide 65, so I put the two of my favorite charts in macro. This is the most important chart in macro, in my opinion. Put those kind of back to back. The blue line is showing employee compensation as a percent of gross value added. That's the widest proxy of revenue that the BEA measures. And then you look at corporate profits. Corporate profits as a percent of GDP is the red line. Right, like you look at where the blue line is now relative to its pre-2000 average, or where the red line is relative to its pre-2000 average. This is what's fueling the populism. In fact, I would argue the blue line being where it was in 2015, 2016, and the red line being where it was in that time period is what got Donald Trump elected. The guy wasn't a politician. It's not like he had any formal training or his experience as a politician. He just picked up. Steve Bannon really picked up on this. Steve Bannon was obviously educated by my former colleague Neil Howe, who again is truly one of the most remarkable individuals in all of macro and all investing, really. They picked up on this. And again, the charts have obviously recovered as the blue line always recovers in a recession, right? Like it goes up in recession because profits are going down. But it's really, okay, where are we settling down to? Where is this blue line going to be when we're done with this recession, like 6 months from now? Is it going to be back in the high 50s, low 60s? And again, if it's back in the high 50s, low 60s, that's still not high enough for where the mood of the country needs it to go. The mood of the country is pissed off that red line is as high as it is. The red line used to go to the 7% range, it would be down there, 7-8%. That's where corporate profits as a percent of GDP were. They've been persistently above 10 for nearly 20 years. And so I'm not defending corporations. I'm not against corporations. I'm not anything. I don't have a dog in this race. I'm just telling you, this is a very important chart. And it's what's driving the U.S. political cycle towards populism on a bipartisan basis. So definitely keep this in mind as you think about where the dollar might be headed. Those two charts give me a lot of confidence in my negative dollar view from a long-term perspective. Because again, I don't think we're going back to the Paul Ryan fiscal retrenchment, some man Ron Paul days, that I kind of dealt with early in my career. We're not doing that. We're going towards Argentina and Venezuela and Erdogan and Turkey. That's where we're headed. Again, not in a linear fashion, but certainly by the end of the fourth term, which again might be 6 to 8 years away. On slide 66. So why is the Fed looking through all-time high labor demand? This is JOLTS. The blue line is JOLTS, and the red line is the NFIB job openings hard to fill survey. Obviously, both making all-time highs in the most recent month. Is on slide 67. It's because of the shortfall in total employment. We're still down. If you look at total non-farm payroll, it's still 5% off the peak in terms of total non-farm payroll. It's like, what? Why are people talking about tapering? Look at this blue line. The Fed told you they have a shortfall framework, and obviously there's a massive shortfall still. Went from down 15 off the peak in percentage terms to down 5. That's not closing the shortfall. Why are these people doing anything? I think the market is ahead of itself on this tapering talk, and the bond market is telling you that. And quite frankly, if I'm being honest and can take a victory lap, I think I was the first person to say, I think this is the market is ahead of itself on taper. I didn't hear anybody making those calls, at the lows of May. So, we are obviously positioned for that in terms of being long treasuries, long gold, long the Swiss franc, things like that. But obviously the dollar will give us a lot of confidence. Or the dollar will give us, again, a lot of, so if you think about barbelling portfolios and creating inversely correlated assets, or having, uncorrelated assets, or more importantly, inversely correlating heading into a market regime transition. If I'm just dead wrong on reflation surviving the next couple of months or transition to Goldilocks, the dollar will give us a lot of wiggle room to get out of the other exposure. So I'm confident on that front. On slide 68, so again, the labor market recovery, I wrote about this in my note on Friday, is being held back by supply side constraints. You look at this as the labor force participation rate, it's 61%, it was around 63, 64% just ahead of the pandemic. It's 8.5% off its highs. This is QE can't do anything to fix that, right? Like, there's nothing QE can do to get mothers back to work who are homeschooling children. There's nothing QE can do to get people off the couch from collecting, free money from the government and back into the labor force. Like that they're not buying $120 billion of bonds a month to fix this line. It has no bearing on that line. So again, the reason I think, Jay Powell has been so reluctant to tighten policy is, again, they're going back to, the mistakes that they made in 2010 and 2011. I highlighted on slide 62. But moving ahead at slide 69, let me just take a break here. I've been ranting for a while now. The U.S. economy is still in recession. Like, we keep hearing this tapering stuff, and then you look at the output gap and it's like, why are we talking about tapering? Like, we're in the middle of a deep recession still, so I just want to call that out. Slide 70, I want to call out the fact that corporate profits are still down 7% from their highs. We're still in an earnings recession, technically speaking. On slide 71, you look at services consumption, that remains depressed as open table seated diners, the percent change from the baseline in 2019, that's down 8% still. On slide 72, this is TSA checkpoints, so the coast is clear from a pandemic perspective, domestically speaking, like people can get vaccines, that's accelerating. We're eventually going to hit frictional resistance by people who don't believe in vaccinations. But that's neither here nor there. But but the coast is sort of clear on the pandemic, right? We're getting back towards normal. But then you look at TSA total traveler throughput in terms of the drawdown there that we're seeing from the baseline. We're still down 42%, from that baseline. Like, things are not back to normal. What the hell are we talking about tapering for? Let's just enjoy this bull market. Why can't we all just enjoy the bull market? Like, this is what Paul Tudor Jones has taught us. The last third of a market cycle is the hardest third to risk manage, because the bulls sell too early, or the bears start shorting too early, and in the bear market, the bulls start buying too early. This is where you got to be good at sitting in these seats if you want to make money. Because it's so easy to sell in May and go away and then come back in July and buy a higher price, right? I think a lot of people are likely to do that if we're right on the market regime staying in inflation and or transition to Goldilocks over the next couple of months. I think a lot of people are going to say, man, I sold in May and I got to chase. And that'll be a very, very inopportune time to chase. Just so if you're going to do that, I would say the best possible thing to do is just stay with your position. Do not sell in May and come back in July. That would be a really stupid thing to do, in my opinion. On slide 73, so everything I just highlighted about the U.S. economy still being depressed from a shortfall perspective, from a labor shortfall perspective, from an economic perspective, labor supply, obviously QE is not going to have any impact on that. All those things coalesce into, giving me a lot of confidence to say what I'm about to say, which is, the Fed's rhetorical policy pivot, i.e. saying out loud, Jay Powell saying, okay, we are now talking about when we're talking about tapering. We think tapering is going to be January 22, when they start putting dates on the calendar. That rhetorical pivot is when the market expected, that's when the market will say the liquidity's gone. The market's not going to say liquidity's gone when the Fed starts tapering. That's 6-9 months from now. The market is going to really think liquidity. The market is going to feel like liquidity dries up when the Fed actually makes that rhetorical pivot. People have to really close out a lot of, kind of late and long exposures. So, right now, the bond market is telling you, they're not ready to pivot. Right? You look at what happened on Friday in the 10-year yield. I mean, geez, if you need a signal, just notice the particular, right? That's the Mandelbrot. It's particular things at particular times. We've learned that from Benoit Mandelbrot, and this is one of those signals. It's like, hey, stop worrying about this tapering stuff. We're not there yet. Relax. Enjoy the bull market. In slide 74, did investor consensus sell too soon? You look at cash and we're about to make a new high in cash. And if we keep this pace up over the next few weeks, like you look at it, like normally we're raising cash when financial conditions are tightening. Investors are raising cash because like as financial conditions ease. So like either everybody is like a genius and they're like perfectly getting out right at the top, or what's more likely to happen is that that cash that people raise is going to get deployed into higher prices because we stayed in a positive market regime cycle. Again, everything I'm saying is a function of the global macro risk matrix at the front of the presentation telling me that reflation is the dominant macro regime. If there was, not only is it telling me inflation is dominant macro regime, but by a wide margin. And the next closest macro regime is Goldilocks, which is also extremely positive. Like it's not, we're not at this like awkward moment where like it could be reflation or deflation or, where there's a lot more, lot less dispersion amongst those outcomes from a probability perspective. There's a tremendous amount of dispersion and it's telling me to be bullish. So if I sound like I'm one of the most wacky people in finance right now, I'm happy to, because again, it's all backed by math and data. I'm just trying to entertain you to some degree to get through 100 some slides of data. But at the end of the day, I'm not here to entertain you. I'm here to help you make and save money. That's what we do at Team 42. We make and save money. And we use math to do so, not narratives, not stories. Math, make, save money. Bingo. On slide 75, so again, I mentioned this, there's an elevated risk of asset markets, trading like Goldilocks. If we learned anything from the bond market move on Friday through the end of July, but, from a seasonality perspective, it can get ugly from there. You're looking at August, September from a seasonality perspective. And then on slide 76, bond market seasonality agrees with that view, right? Like, okay, maybe we actually, because the Fed's reaction function is delayed relative to when they would have historically, made a mistake, a policy error, maybe they'll make the policy error a few months later. And so that gives you more upside. A lot of people are going to have to unfortunately get squeezed on the shorts if we're right on reflation surviving. And again, we're not saying reflation has to survive. We will change if it changes. We're just saying that we don't see any reason for it to change because again, the bottom up macro regime is in reflation here in June. So why would I expect it to change here in June? No, I don't. And then the top down market regime is still reflation as well. So again, we'll make the pivot when we need to make the pivot, but right now I'm not gonna lose sleep over all the myriad of things that can happen. Right, the range of probable outcomes is always extremely wide, and the whole point of doing all this work and doing all this math is to narrow that range of probable outcomes so that I can actually make investment decisions and sleep at night. That's it. Everything else is neither here nor there. So getting back into the process here on slide 77, just kind of highlighting the asset allocation framework again. We need to hit on that on 78, 79, getting back to the portfolio construction. So this is where we are, feeling good about that real estate ad. Again, I mentioned dollar, it's bearish, but this will help us sleep at night to the extent I'm wrong on the likely duration of inflation surviving as the modal outcome from a market regime perspective. Getting into the back test. So how to read these charts here on slide 80, the next series of charts. What I'm doing is I'm actually averaging the mean volatility and covariance ranking, for the various styles of grid market or macro regimes that backtest that we're pulling in. And so for reflation, for instance, there's several different categories and features that we can actually select to give us different information about how these assets are likely to behave. So we obviously have the regime itself, reflation. Then how fast is growth accelerating in inflation? Right now, I have it as a 0 sigma because we're kind of caressing the cycle peak. We've already hit the max acceleration was in the spring, in the winter and the spring of this year. So 0 sigma delta on growth, 2 sigma delta on CPI. We're still in the fast upslope as it relates to inflation. No expectations on policy rate maneuvers. From a reflation perspective, no expectation on change in QE policy, no expectation on change in fiscal policy as well in terms of inflation. So all those different back tests, we're blending them together across volatility, covariance, expected return, and percent positive ratios. And then for the risk scores, we're just averaging the rankings of the volatility and covariance rankings. And then for the reward scores, we're just averaging the mean expected return and percent positive ratios. You see what I mean? So we're trying to say the x-axis is further out on the x-axis you get, the more risk you have, and the higher up on the y-axis on these charts you get, the more reward you have. So ideally, if you're going long things that are towards the top left of the chart or towards the top left of the cluster of dots, and then you're shorting things towards the bottom right. That's as simple as it. And then you generally speaking, unless you have a real compelling reason, you probably want to largely ignore most of the stuff in the middle. it'll get it. Everything has its time to shine based on how those back tests are being orchestrated. So this is what the chart looks like from a reflation perspective. Here on slide 80, slide 81, this is global equity. So again, same analyses. I'm just doing it across the 5 liquid asset classes: U.S. equities, global equities, commodities, fixed income, and FX. Same back test, same process. Again, just different asset classes to get us to these summary charts here. So again, on slide 82, commodities, 83, fixed income, and 84 is foreign exchange. And then when you get to 85 here, what I'm actually doing is I'm actually dividing the x-axis by the y-axis in the previous charts to get to the x-axis in this chart. So I'm looking at the risk-reward ratio. So how much risk relative to reward you're getting. Obviously, the further out on this chart to the right, you don't want to be there on the long side because you're taking a lot of risk to get minimum amount of reward. And then obviously you want to be further to the left on the x-axis. And then on the y-axis, I'm just showing the annualized expected return, but that on a ranking basis. I don't want to have Bitcoin in there with the dollar. You won't be able to see the dollar dot. So again, I'm just showing the rankings, and then I winsorized that on slide 86 to kind of give you, okay, this is where you should be thinking about from a portfolio. These are your candidates to actually make it into the portfolio. These are the things that survive the back test the best. They have decent risk reward ratios. They have high annualized expected return rankings. And so when I start to think about, okay, which dots do I take from this page and push through my volatility adjusted momentum signal to see if it's bullish or bearish, these are the dots that I'm actually looking for. I would just winsorize the sample from 150 different exposures down to about 50. I don't want to be long everything or short everything. I want to be long things that have the highest expected return relative to the amount of risk that they're taking, given this style of reflation that we're seeing. And I want to be short things that have the lowest expected return relative to the risk we're taking, given the style of reflation that we're seeing. Again, I don't have time yet to incorporate shorts, but eventually we'll have resources to do that as well. And then I do the same process for the deflation backtest as well on slide 87 here. So again, same exact process, but again, I have to do the process for the 70% of the portfolio that's reflation. And then I have to do the same exact process, but just, I wouldn't say in reverse, but it's for the 30% that is deflation. These are 2 separate processes for 2 separate sleeves of the portfolio. Again, it sounds complex, but all it really means is we're trying to figure out how to barbell appropriately. We want to use math and data to barbell, not narratives and storytelling, right? So when I adjust for the style of deflation that we're likely to see, so how I set the deflation back test, we have obviously deflation, the main grid regime. We have 0 sigma deltas on the decel on growth, 0 sigma deltas on the decel on inflation. Because again, I mentioned inflation is likely to stay high and sticky, even though it's decelerating throughout our projection period. So 0 sigma deltas on both. No expectations to a change in policy rate, but I did actually select the QT back test, the deflation QT back test. I put it into the model there as well, because again, we do expect at least a rhetorical policy pivot out of the Fed, and I suspect asset markets will treat that as if it were QT historically, and then fiscal policy tightening. So you're going to go from max fiscal policy easing in Q1, early part of Q2, and you have a lull in terms of the budget deficit. It's going to tighten throughout the summertime, and it's going to tighten until they get Biden's sort of budget passed in the second half of this year from a reconciliation perspective and infrastructure. So that's like a Q4 event. So you have this kind of like 6-month window where we're well past peak in terms of fiscal policy and fiscal stimulus. So I actually selected the fiscal tightening back test as well to really shock the model and get us into the appropriate back test from a risk off perspective. I don't want to be cognizant of we want to be cognizant of the risk off nature of asset markets, that the behavior that they might exhibit in the second half of this year. So you look at the kinds of U.S. equities that would outperform in the context of everything I just said about the deflation back test. It's healthcare, it's REITs, it's utilities, it's staples, it's low beta, it's high dividend. It's the usual suspects. And then you look at what's likely to underperform. It's the usual suspects there as well. It's the techs, it's the cyclicals, it's the digital and real economy plays. What you really want to be long is defense in the context of those back tests. So we selected REITs. Naturally speaking, going back to the dynamic asset allocation process. The reason we're not selecting more U.S. equities is because in deflation, you don't want to be long too many equities, right? You want to be 80% or sorry, 70% fixed income and 30% in inflation, or sorry, equities and commodities. My apologies. All right, so global equities, same process on 88, 89 commodities, 90 fixed income. It's the usual suspects, TLTs, the EDVs, the LQDs. It's the duration plays, right? Like, you know, I'm probably going to be the only macro strategist this year to say, coming into the year, screaming at people that we're going to see a record convexity to the downside in bond prices. And then you might actually see record convexity to the upside in bond prices at some point in the second half of the year. Only someone with a data-driven, cyclical, respectful cycle, a process that's respectful of market and economic cycles can tell you that, right? Most investors that I look at are either deflationistas or inflationistas, and I want to be a money-makinista. I want to be the guy who makes money, not the guy who has a good story or a good chart deck to show you. On slide 91, the FX back test, that's, you see that UUP there. That's what that. And by the way, I'm not back testing the ETFs. I'm back testing the underlying exposures that the ETFs represent. And so that gives you obviously much more time series to study as it relates to each of these exposures than the ETFs would. But again, that's the UUP there. This is where I'm, okay, should I be long the dollar? I mean, the chart sickens me. And it's obviously bearish from the volatility adjusted momentum signal basis. But hey, look, slide 91, it's like, this is what you really want to be long, are things that are at the top left of the chart, right? Like this. So I'm like just hold my nose and put it in there, because again, you look at what happened to the dollar on last Thursday, the thing looked like a penny stock. And I'm like, okay, that's if I'm wrong in this reflation trade, that'll help me big time. So we want to actually have that in there. So I'm violating my rule to an extent, but it's a real thought out violation of the rule. So please don't kill me for that. I'm sure you guys won't. On slide 92, so this is the deflation global macro backtest summary. Again, on the x-axis, it's the risk reward ratio. So go back one chart on slide 91. I'm just dividing the x-axis by the y-axis ranking, and you get to the risk reward ratio. And then on the y-axis, you're showing the annualized expected return ranking. And then I winterize that on slide 93 into the portfolio construction candidates. So again, when I think about the 30% of the portfolio that we want to have in deflation, these are the dots that I'm going to push through the volatility adjusted momentum signal process to, decide whether or not we're long it or short it. And so obviously the things that, survived or demonstrated in the portfolio construction process. So, we're kind of getting towards the end here. I mentioned there was a lot of data in the appendix that I want to highlight. I'm not going to go through all the charts. We're on slide 94 here, looking at the grid asset market backtest charts. I'll just give you some heads up on how to read some of these charts and tables, and I'll let you guys take it from there, just so we can land the plane and I can actually get some food in my belly today. On slide 94 here. So looking at S&P 500. So the top left chart shows the annualized expected return across the different grid regimes. So you got, let me just read them across, just for those of you who sort of struggle with seeing these things. It's Goldilocks, reflation, inflation, deflation. And then you have 0 sigma deltas on grid. Then you have the -2 sigma deltas on grid. They have the +2 sigma deltas on grid. So for example, for growth, these are for growth. And so for example, if you have a -2 sigma delta for a deflation regime, that obviously means growth is slowing sharply in a deflation regime. If you have a +2 sigma delta on a reflation regime, that means growth is accelerating sharply in a reflation regime. And I do the same thing for inflation as well. And then we have policy rate easing, tightening, QE, QT, fiscal policy easing and tightening. And then I have, looking at what the world looks like, what the asset markets do when the world is, when you marry up the US grid regime relative to the world grid regime. And so, again, what I'm trying to do is actually study each of the observations in the duration of the back test that meet those criteria. So obviously, Goldilocks, reflation, inflation, and deflation are the 4 main criterias. That'll encompass every single sort of observation, and then you can actually winterize a sample from there to get to things that match these secondary metrics, these secondary criteria, to kind of better understand how asset markets have historically responded to things that are actually very important, like fiscal and monetary policy, like the speed of an acceleration or deceleration, and what the rest of the world is doing from a grid perspective as well. So I just wanted to help you guys read those charts. Top right is percent positive ratio, then move down to the middle column. The left side is the percentile of expected return. The right one is volatility. The bottom left is in size, and then the Bottom right is the covariance with US equity beta. Obviously, this is S&P 500 chart, so you're going to have ones across the board. 95, you can see how that changes when you're looking at a different exposure. Skipping ahead, look at slide 99. So how to read these tables. These are the tables that kind of contribute to those scatter plots, those portfolio construction scatter plots, and those asset class backtest scatter plots. So we're looking at the macro regime. We're looking at the growth delta. What is that delta z-score? What is the inflation z-score? Again, what I expect to happen or what I'm observing in the economy. The policy rate is doing, what the balance sheet is doing. Easing is QE, tightening is QT. Fiscal policy easing, the budget deficit's getting wider. Easing, if the budget deficit is tightening on a percentage basis, it's tightening. And then what's the rest of the world doing in the context of what the U.S. is doing. So for the reflation part, the 70%, where we've been, it's the whole world's in inflation. We're in inflation, they're in inflation. So we get a couple of R's together. And then I'm blending all those individual back tests. Each one of these columns is its own back test, right? And I'm selecting them from a series of back tests that we highlighted in the busy chart. But what I'm trying to do is actually just rank this blended annualized expected return across each of these different U.S. equity sectors and style factors. I'm doing that on slide 100. I'm doing that for percent positive ratios. On slide 101, I'm doing it for volatility. And on slide 102, I'm doing it for covariance. And I'm not just doing it for U.S. equities. I'm doing it for every single liquid asset class. So again, I'm shocking the model to understand how things are likely to behave based on what I expect to happen, both from an economic perspective and from a policy perspective. And then on slide 119, again, I mentioned we're doing the same thing for the 30% of the portfolio that is deflation. So deflation is the macro regime. Both growth and inflation have 0 sigma deltas projected. Policy rate, no dice there. But then I put the policy QT bound back test in there. I selected the fiscal policy tightening back test in there because, again, I think not only are you going to see a rhetorical pivot out of the Fed towards tapering, which I think the market will interpret as tightening, and then you're likely to see not only outright tightening from the perspective of the budget deficit. It's going to get less wide over the next sort of 6 months until we get that Biden budget pass and infrastructure pass. But more importantly, on the passage of that, there's a not insignificant probability that we see a bigger haircut than the market is currently worried about in terms of that reconciliation process. So I think both of those dynamics, we talk about tapering, you talk about a bigger haircut than investors expect, that could be interpreted as a tightening as well. So I want to have that back test shocking the model, shocking the back test to get me to the right dots on the right part of the page on those asset class back test charts. And then again, I'm blending the annualized expected return on slide 120, blending the percent positive ratios on slide 121, blending the volatility, and on slide 122, blending the covariance to get into those portfolio construction candidate slides. And then on slide 139, this is re-highlighting our current portfolio construction in the context of everything I just explained. That's how you get to these particular exposures being on the page, because those are the dots that are close to the top left of the charts in those scatter plots. And then again, they survive the secondary overlay that is our volatility adjusted momentum signal. And then lastly, we wrap up slide 140 through 161, I believe, is slide 140 through 159 are the grid asset market backtest slides or analyses for each of the 20 exposures in the portfolio construction. And then lastly, just to finish strong here on slide 159, we have the US dollar index backtest. Obviously, the dollars, again, I mentioned bearish from a volatility adjusted momentum signal perspective, and that's actually giving a lot of positive signals across our global macro risk matrix. But the one thing that I observed, again, going back to the Mandelbrot, noticing particular things at particular times. On slide 160 here, you look at what happened to the dollar on Thursday on the ADP print. Like, I don't know what data point is going to cause the Fed to really materially change, or Jay Powell to change his tone. Again, I think the tone change is the second half of the year, earliest late July, latest sometime in September pivot. And so, but if I'm wrong on that view, then the dollar again is going to be one of those assets that's going to do really, really positively in the event of a near-term taper or just a market regime transition into deflation. Because again, that's what the math says on the back test. But again, this is what we're observing in real time as well. So that's something to call out. And then on slide 161, it's everyone's favorite slide. It's my least favorite slide because again, this slide is too simple. I'm a firm believer in Einstein's approach. You simplify the complex until you but you don't want to simplify it to the point where you're actually losing information. You want to distill, the information into a signal. But the second you start distilling the information into noise, that's when the process breaks down. And I do think there's a lot of noise inherent with this slide because, again, this doesn't take into account the size of the growth and inflation deltas, doesn't take into account policy rate, doesn't take into account central bank balance sheet, doesn't take into account fiscal policy, doesn't take into account what the rest of the world do. These are just the overall, kind of max in size back tests across Goldilocks, inflation, deflation. So I think it's instructive to have is, again, for those of you who aren't Protocol subscribers, I'm not on the Zoom meetings with you guys going through, your particular exposure, what you care about, what you can invest in, what you can invest in the context of our outlook. So I do want to leave this in there for those of you who are following along at home and kind of want to start to think about, the kinds of exposures you want to maybe tiptoe into or get out of ahead of a potential macro or market regime transition. But the reality is, I think the best way to do that, in my opinion, is not with this slide. It's with the portfolio construction process slides and all those scatter plots that are associated with those slides. To me, that's the real meat of where you want to kind of start to think about pivoting to if you want to front run the process. So again, Darius Dell here, tons of information. Hope you guys enjoyed that. Look forward to your feedback on Twitter, and we'll go on from there. Everyone have a blessed week. Thank you.